Good morning, good afternoon, and good evening, depending where you are on the planet. And welcome to the TGI Friday, the Thank God It's Friday, the 18th of November, Bull versus Bear webinar. Steve Miley here on the call for trade day, 1 hour early. So I should imagine that means our friends in the US are not with us. An hour earlier here. So if you are picking this up, maybe on the you might be picking it up on the recording, or so if you tuned in later. I did post it, mention it yesterday. We're starting an hour early just for today. To make that clear, we're back to normal as we go into Monday. So just for today, but for today's TGI Friday webinar, we're running an hour early. I'm going to keep it relatively brief as well, guys. There's not a huge amount to add to what we've been talking about. But we'll run through the calendar, the macroeconomic articles from the major news wires, and the charts. We'll certainly be going through all of that. But not a huge amount, so it's going to be relatively brief in here at the moment. So let's take a look at the calendar. We have had some relatively important data out of the UK, beating expectations in here. Retail sales data not falling by as much as I anticipated. So that was a good sign in here. That's lifted the pound higher in here this morning. And I think, let me have a quick look on the European stock indices. Where are we on FTSE in this morning? Yeah, we're higher on the FTSE as well. So FTSE's up. All European exchanges actually higher in here this morning with a rebound overnight. We get to get that setback yesterday. Recouped most of those losses already in Europe this morning, and the US futures also doing that. So we'll jump to that. Just getting a little bit out of order in here. But we did dip lower. It wasn't a huge dip, only 1/3%, but we were lower than that obviously yesterday on the S&P, and then rebounded from the lows, and now we're up in here. The S&P's up 6/10, so actually up from the day before yesterday's close. So the market, dipping lower, sending some negative signals, rejecting those yesterday. Intraday rebound, looking a little bit more positive despite the negative price action we saw yesterday. So that late session bounce and the follow through overnight bounce kind of negating. I kind of switched to more negative in here. Morning, Clinton, you're on. Okay, good. We did switch to slightly more negative on my daily outlook in here, but a lot of that negativity has been negated already by the overnight price action in here. And so if anything, I think, coming into today, I'm actually looking more positive compared to where I was even 12 hours or 12, 14 hours ago on the US close. So the market, certainly intraday rebounds we've seen have been fairly firm. So retail sales in the UK slightly helping that. There was an article on that. I don't know if I opened that, but retail sales better than expected, lifting the pound, lifting the FTSE in here this morning. In European data, nothing really of significance. Lagarde has been speaking in here, and there's a few bits on that from the ECB. Lagarde says rates to rise more may need to become restrictive. So there had been, the ECB, for those of you in the US and not so familiar with the workings of the ECB are very, 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 very much more dovish than many other central banks. They have been that way almost since their inception. They've got this history of being very, very dovish. And it was almost a bit of a surprise when they shifted to slightly more hawkish more recently. We had the 75 basis point rate hike. Then there's been a lot of talk and coming out from ECB speakers more recently that maybe they're not going to go too high on rate hikes. Maybe there's going to be, they'll start tempering those rate hikes. But what we've actually seen in here from this morning is we've seen, so maybe moderating that previous large rate hike and maybe moving towards more of a gradual rate hike. So they 75 last time, maybe going to 50. But, it seems in here appetite for another major jumbo hike next month may be waning. So that has been said, but because there's rates to be rise more may need to be restricted. So kind of mixed messages in here. President says risk of euro area recession has increased. Well, there's no surprises there with everything that's going on with a huge war on the doorstep, and with energy prices, particularly in Europe, significantly up from where they were a year or so ago. So that's going on. So stocks are up though overnight in here. Stocks rise with yields rising as well as Fed's message is digested. Retreats after surging on Bullard's rate warning. So even though the Fed continues, I was talking to another technical analyst and also a macro analyst yesterday. The Fed continues, to send these relatively They're trying to get the market away from thinking pivot, started to get them to try and move away from that the Fed is shifting more dovish. These are all the messages that they're trying to send, okay? Even though they have said, and the market, as we've looked at repeatedly, continues to price in only a 50 on the next meeting, right? So here we are up at 80% on the Fed tool. And the peaking rates, as we said, next summer is lower than actually. This is nudged back up again, right? No, this was at 525, 550 previously. So now it's at 500, 525 in here. The peaking rate's 500, 525. And then by the time we get to in here by September and November, we're looking at 475, 500. So the peaking rate's potentially nudging a little bit higher, sitting or up, kind of where it has been. Still looking for a rate cut going into the, basically in a year's time. However, the market in here, if you go and take a look at what the yield is doing, if we go and take a look at the 10-year, I'm going to just pop this out as an interactive chart. It's going to take a little second to load. We had this big push lower in yields. Okay. Yes, we've had a kind of a slight move. And, as it says in here on the recap article, right? We'll come back to that. Stocks rise with yields. So yields have risen this morning and stocks have risen this morning. So you can see in there in the chart, yes, yields are up, right? This is yields pushing higher, right? Slightly higher yesterday, slightly higher this morning. But look, we're still inside Wednesday's activity in here. Okay. So here's today, here's yesterday, here's Wednesday's activity. We're still inside the range of that day. And so all the negativity, all the lower yield pressures that came from this big move are still very much intact, despite this little blip higher. This is like a dead cat bounce, if you will, in yields. For me, all the pressure is still down in yields. As much as the Fed are starting to try and get us to say, hey, we're not pivoting. We're not going to a more dovish tone. We're staying hawkish. Hawkish is pointing up, remember, higher yields. Dovish is pointing down. As much as they're trying to say, this move in here, they're trying to say, yeah, maybe this is too much, guys. Maybe we should be back up here. So what the Fed are trying to talk us more into this position here. But the market is saying, yeah, we're not really buying it. We think, yields are going lower from here. 10-year yields are going lower. We're certainly seeing that, even though we had a little blip higher in yields over the last 24, 36 hours. Okay, let's go back to the tapes in here. And so let's finish this off in here. Nothing of real note this afternoon. MPC member Haskell, that's from the Bank of England, speaking today. This is all blah, blah, blah. Nothing of real note. Existing home sales rarely moves the market. So let's take a look at 5 things you need to start your day. Now, I didn't see one come through from the US in here. So this is kind of the European one in here, but nothing really, huge in here. We had, obviously, yesterday we spoke already about the autumn statement. It was fairly bleak, but the market took it fairly well. The market was delivered what it kind of wanted. I think, there's enough tax hikes and spending cuts to keep the market happy and stabilize public finances. So the market took that fairly well overall. Elon Musk, exodus at Twitter, people walking out the door. And what else we have? Giorgia Meloni's government will devote about 30 billion for experimenting her first president, Italian prime minister. Not really impacting us. Further chaos. I don't know if you saw the statement from the new CEO, the administrator of, it was just absolutely awful. The administrator of, John J. Where is it? Oh, this is it here. Yeah, look, everyone was talking to him. So he said it's worse than Enron. He's never seen anything as bad as this John J. Ray III. Super, super negative, his statements on that. But again, not really impacting us. The all the negativity from Bitcoin, from FTX is all built in. Bitcoin's kind of stabilized, and the major currencies have stabilized down. The cryptocurrencies have stabilized, and they're not really now pulling the broader market lower with them. There's the emerald thing. Oil continues to go lower in here. It was a very negative session yesterday, and looks far more negative going into today as well. Second week of declines. Real concerns about ongoing demand going forward. Concerns about are China really coming out of the COVID zero COVID policy, and real concerns about global recession going forward. So oil reacting that way. Bank of America in here, their strategies coming through from the back of the fund manager survey, I think, they see this as a bear market rally. They see it fizzing out, even though equity inflows are surging. Remember, we've been saying how underweight the market is from the fund manager survey in here. Well, they are seeing surging inflows into equities. Okay, global stock funds saw inflows of 22.9 billion in the week through November, December 16th. So so that's even though it's but Bank of America saying that they think this is a bear market rally. It's a bounce rather than a full new bull market. And we've already spoken about the ECB. I'm just going to go a quick run through on this. This is looking into next week. So Reuters do this take 5. So this is actually looking ahead to next week. So they're focusing on the fact that it's Black Friday. How will the traditional retailers, how will retailers do through Black Friday / Cyber Monday? What else do we have in here? The rise of the US dollar has been dominant trading theme. Is that it for the dollar? They're talking about that. What else we got in there? IMF outlook even gloomier. China zero COVID policy in here. And the World Cup kicks off on Sunday. For those of you in the US who may not follow what we call football, which I call proper football, we have the World Cup, the Football World Cup. It's kicking off. It's in the winter this year for the first time ever. It's in Qatar because it's so hot. Obviously, they can't hold it in the summer. Very controversial. Holding it in Qatar, given their human rights policies, etc. But I won't go into that. We don't want to politicize this whole thing. But nevertheless, that does start on Sunday, the World Cup. What else do I have for you? Fed to lift rates by 50 basis points, but peak policy rate may be higher in here. So yeah, we've been told this. They keep telling us this. That was what that's what Powell told us. Back. Maybe we need to slow, but maybe the peak's going to get higher. And the Fed funds rate. This is what we look at. The fund rate with the Fed has raised in the is one of the fastest rates. So expected to peak a minimum 475. However, this is what we look at every day, right, guys? So they're talking about it in here, and this is just a Reuters survey in here on where Fed funds will go to. We've looked at these already. That's what we've got on the bourses in Europe. We're up about 1%, and we're up in here around 0.5 to 0.75% on the Dow, S&P, and Nasdaq this morning. Let's dip into the chart. So even though from last night, things were looking quite negative, we got a late session rally, then we got an overnight rally, and we've pushed higher again. So it's almost like this sell-off that we'd already seen this beginning. This is the S&P, by the way, guys. The sell-off that we saw yesterday, and it was looking more negative, and that played out yesterday. The intraday turnaround. Now, from the beginning of the week in here, this was Tuesday, we get this shooting star negative candlestick, which took us lower for a couple of days. Now we've got a hammer candlestick, okay, from yesterday, which is a positive candlestick. So, and then we're building on that already today. If we were trading down here, I would say, well, yeah, we had a hammer, but then the market looks weak. But we're all the way back up towards yesterday's highs in here. We're pretty much at the closing point where we were from last Wednesday. In fact, if anything, we're above Wednesday's close. There's Wednesday's close. So we're above Wednesday's close. So this is actually, if you look at the closing points from the week, that's the highest close. That's from last week. The highest close from this week, on the candlesticks is here. We're only just below the highest close for the week, okay? And not far off the highest close we've had for months, okay? That's the highest close for months that we posted back on Friday. So, we're not far off of posting an up week. So, yeah, market's looking the turnaround overnight, even though I was up more negative in my reports. The report, remember, was written, where are we on the report? So that would have been, where's the close? The close was in here. So the market was still looking fairly negative and failing at that point. And then we've had a decent rebound since then. So it's still looking fairly negative into the close. And then we get this pop higher, around the close, and then, overnight as well. So it kind of, we said about this topping pattern, multi-point topping pattern, head and shoulders with multiple shoulders, whatever it might be. We broke the neckline, all looked more negative. You see, we've gone back up to the neckline and faded. And then now we're back up through. If we extrapolate that neckline out, we're back above the neckline. So for me, this is quite positive. The trigger point for me on the outside is definitely these two failure peaks in here. So 39.85 and 39. Oh, no, maybe it wasn't 85. 39.90, 91, really, 91 and a quarter. Up through there, it looks even more bullish in here. And we could easily see this push up into this area here around 14.15, 14.20 up to the top side. Initial trigger point on the downside, this little swing low in here from an hour or so ago. That is down at 39.63 and a half. And then we've got the trend line that comes off the lows through the overnight lows. and that's going to be all the way down at like 49, and then you got the overnight swing low at 43.5. So those are the trigger points on the downside. Similar story for the Nasdaq. Look, this big, kind of hammer pattern in here, big rejection. Back to 3 days ago, 4 days ago, we had the shooting star. Now we get the hammer. We get the follow through from the hammer. Again, we're not far off posting a high close, a multi-week, multi-month high close. That'll put us, back above 11,900. We'll see that, and looking positive. When we go into the 15-minute chart, again, look, there's that neckline, breaking back above that neckline, holding there. Again, similar points just above where we are now. 12,827.5 and 830. So 825, 830 area is a lot more bullish in here. Again, on the downside, I've got the trend line that comes off the low, and then the morning low here. So, and then you got a little swing in there. So the little swing is at 11,741.5. The trend line comes in around 11,700. The other swing, this morning's low, is 672.25. Those would be the downside triggers. But on the upside, we take out really 11,830, and then this all looks a lot more bullish again. Very quick nod to the commodity markets. Start with gold. On the daily, been really resilient consolidation. Remember, this is positively correlated with the equity markets. We had a really strong push up with the equity markets and hardly a dip. We did get a bit more of a dip yesterday, but it's held support and we're bouncing. If we get a strong equity rally this morning, we could see another explosion to the top side on gold. It has been very much in consolidation, broad consolidation in here. Having had those impulsive rallies previously, you could argue that's a topping pattern forming, right? I'm just going to widen this out a bit. Could happen to argue it's topping, but it doesn't want to form that top. It doesn't want to complete that top. Really rejecting the completion of that top through here. Look, it held that low there and it's oscillating a bit higher up through this trend line. Back above that little peak there for me would be bullish. 1770.8 would be my trigger on the top side for gold. It takes out the line in here. It gets down through like 1755. It looks a lot more negative. Oil can only be bearish. Big down day yesterday. We said to go down into this region here, this shoulder. I think initial target around that low there for yesterday at 82.63, maybe as deep as down into here towards 81.30, where we've got close already to, I think we're not quite 81.30. Have we hit 81.30 yet? Oh, we have. We've broken 81.30. Real threat for another push on oil down to into the head now. And that low there will be my target, 78.36 on the downside for oil. If we go into the 15-minute, it only looks bearish. You can't see anything bullish about that. Plunge lower yesterday, dead cat bounce, lower again. Short for me. Right, I'm going to wrap it up there. I'm going to wish you all not only a great trading day, but also a wonderful weekend. I'll be back with you on Monday, back at the normal time. So apologies for getting you up early. If any of you did get up early, guys. For those of you catching us on the recording, I hope you find this useful. And I will be back with the Bull versus Bear webinar on Monday. Great weekend, guys. Take care.